Better System Trader, Episode 7.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast, Episode 7. Today's guest has been a full-time market professional since 2001. He first began publishing his market views and research in 2003, publishing twice a week on tradingmarkets.com between 2003 and 2007. In 2008 and in 2012, he launched two websites, both using historical analysis to assess current market action and odds. He utilizes price action, volume, breadth, sentiment, seasonality, liquidity flows, and more to conduct his research. In 2010, he published a quant study on Fed days which received high acclaim from many in the industry. His work has been widely referenced and quoted over the years and is often linked to in blogs, tweets, magazines, books, and more. He's also served as a guest speaker at a number of speaking engagements. In today's chat, we discuss how he comes up with so many unique trading ideas, the type of market behaviours to look out for, and his favourite piece of information in a backtest. Here's a clue, it's not a number. He also discusses how a confluence of ideas can improve trading results, how to look at market behaviour from different angles, some simple market timing techniques, adjusting strategies based on market conditions, plus loads of trading ideas we can test for ourselves. After the interview is finished, I discuss the session bonus, my top tips from this episode, and a sneak peek at the next episode, so listen out for that. The guest for today is Rob Hanna. I hope you enjoy it. Rob Hanna, thanks for joining us today.
Thank you, Andrew.
So I guess I'd like to start off with a bit of background on how you got into trading.
Well, I guess my first intro to trading was in college. I had an internship on Wall Street at a firm called Garvin Guy Butler, where they traded Fed funds between banks. And I worked on the board. So there was actually a big marker board, like a giant chalkboard, and the brokers would all be on the phones, and they would be yelling out bids and offers, and it was my job to erase the bids and offers and write down the new ones on the board. And that was in 1991 or so. So that's what got me interested in trading. And the one thing I really learned and found out there was that, you see trading at the time, like Trading Places and Wall Street and movies like that were coming out, and it all looked very exciting on TV. Well, that excitement happened typically when the employment report came out or when some other exciting report came out, and it would last for about 5-10 minutes, and then it would be a big lull. Or when the market opened, you'd have everybody screaming at each other and screaming at me because I was writing the things down wrong, and then there would be a big lull, and you'd sit there and talk about whatever, and it was boredom and panic and not much in between.
It must have been difficult to keep up with the quotes during those fast-moving periods.
Yeah, it was. The first day I got there, they said, "Welcome aboard. How are you in math?" I said, "Good. What'd you get in your SATs?" And I told them, and they're like, "Okay, yeah, that's good. Now go sit in the corner and learn your fractions." I'm like, "What?" Like, I know my fractions. Yeah, and they're like, "Yeah, well, if you got 10 of us screaming at you, do you know which is bigger between 5/16 and 7/64 and this and that, and where they all fall between each other? So learn everything from halves, quarters, eighths, and 64ths, and where they all, and 32nds and 64ths, and where they all fall while we're yelling at you." And I'm like, all right. So that was my job the first day. And I did mix it up a few times.
So going from there, how did you get to the style of trading that you're doing today?
Well, it wasn't until actually years later that I actually began getting into trading on my own. So what happened was I worked at Thomson Financial, and I sold their portfolio management software. And I'd go around and I would. It was a long process. It was a big piece of software, and I'd have to learn the business of trading. I'd go into money management firms and learn their whole back office operations and how the trades flow in their office, and we'd have to show them how that would work on our software. And it was typically like a 6-month sales process. So doing that again got me more interested in trading, and I began trading on my own. I read some books, William O'Neill, how to make money in stocks, and day trading was just starting to kick in soon after that as well. So I had some friends show me how they were day trading, and I read a few day trading books. And so when I first started trading, it was a combination of intermediate term investing, which I did with the O'Neill type stuff, and then I'd also try and do some day trading. I normally did that in the morning for like the first half hour the market was open, and that's kind of how I got started doing it, and it's evolved a lot over the years. I did that, part-time for a few years. Eventually I got pretty good at it, and I started trading on my own full-time. And then in 2004, I think it was, so 2004 was my first year where I really didn't make much money at all as far as trading-wise. And a lot of it was that the O'Neill stuff I was doing, I was buying a lot of breakouts that turned into basically rotational moves. So one group of stocks would break out and then they'd fall back. And then you'd get another group break out and they'd fall back. And so what I learned through all that was the fact that the strategies I had did a good job of capturing the trend. But in a choppy market environment, they did a poor job. They also did a poor job of capitalizing on the short side sometimes. So basically, when the market was overbought, I was most at risk because I was riding up these big winners. And when the market pulled back, those big winners were the ones that got hit the hardest. So the leaders basically got smacked down the most when you get near a top. And near a bottom, I was largely underinvested. I would be out of most of my stuff, or I might even be somewhat net short. And you get these big V bottoms that happen in 2001, 2000, and there was several others along the way, many ones. But anytime you're near a bottom, I was not making money. So I basically started doing a study of tops and bottoms to see if I could create strategies for myself that I could use to kind of fill in the holes, is what I saw in my trading. And so that's what I did. And it took me, 6 or 8 months the first time I did a kind of a study like this. And I did a lot of it on charts. I mean, I printed out a massive amount of charts for all the different indices, and I had them running across my wall. You ever see A Beautiful Mind?
Yeah.
All right. That's what the wall in my office looked like. The wall at his place. And I was able to look at the tops and bottoms, and that was the only way I could put them on top of each other at the time, based on my charting software. So I could see what was going on in the different indexes when there was rotations, when there was strong moves in all the different directions. And so that was kind of my first intro. And from there, I created some little systems basically to take advantage of strongly oversold situations. And one of the systems I came up with, I call my catapult system, and I still use it today. And that's been great for me over the years. But that also led me to kind of start, once I figured out, all right, well, the methods I was using really weren't right at tops and bottoms. How were they at different points, and what other things could I uncover? And so I started testing everything. The fact that I was able to test things and learn from them, it got me excited. It got me curious. And in a way that I could teach myself rather than I used to get excited about reading the next trading book. And a lot of times the ideas in there either weren't tested, they didn't fit me well. There was, so once I was able to test my own ideas, that's when I really got excited. And that's when my trading took another turn. And that's when I started quantifying everything. So that's what I do now. You'll never. I quantify everything, and whether it's a mechanical system, something that's fully automated, or something that's just helps me to set my market bias. I do a lot of studies on the market, just little studies. So if you ever read Quantifiable Edges, it's got the I'll do little blog posts, and they'll say, there'll be little seasonal things, or it'll say, the market's been down 3 days in a row, and we're hitting a 20-day low, and we're above the 200-day moving average. How's the market perform the next 3, 4, 5, 6, 7, 8, 9, 10 days from that? And so you can see, all right, well, it's been up 60% of the time, or 70% of the time, or whatever it is, 4 or 5 days later. And just by doing little studies like that, I'm able to set my market bias. So those are the kinds of things that have shaped me over time, just the ability to do those things and my own curiosity.
So going on to testing your own ideas, you've already mentioned Quantifiable Edges, your blog, and you've got another blog called Overnight Edges as well.
Yep.
Those blogs have some very original ideas. Where do you come up with these ideas?
Well, originally, it was just a matter of testing out things that I'd read other places. And then I started trying to test observations about each day. And that's really, when people are trying to come up with ideas on, what they should test or understand what the market's doing right now, that's the easiest way to start. Just look at what the market did today and describe it. It was down 1%. It hit a 10-day low or a 5-day low, or it's coming off of a 50-day high. Breadth was this, volume was high or volume was low. Anything you can use to describe the market action, whether it's what happened today or what's happened over the last week or 2 weeks, anything you can use to describe it, you can then test. So just take a notes or make little observations about what the market is doing, whether that's whatever market you're trading, it doesn't really matter. And then what maybe some correlated or inversely correlated markets are doing as well. And you can see, you'll come up with a lot of ideas to go ahead and test things. Now, I've done a lot of those over time. So what I do after I find something that works for me, or something that looks like it's promising, I'll save it. And then I built a little software application for myself that I call my QuantiFinder. Or that's what I call it with Quantifiable Edges. With Overnight Edges, I have my Edge Finder. It's basically the same idea. Studies I've done in the past, it looks at the market and pulls them up for me. So if it had an edge in the past, I'll get notified that afternoon, and then what I'll do is I'll go back and retest it, because some of them may have worked years ago and may not be working anymore, or maybe they're getting stronger and working better. But I always retest. I never trust what I did in the past, because the market's always evolving and you got to adapt to it.
Right. So when you're testing an idea, what are you looking for? What catches your attention in the results?
Generally, I look at the percent of time it's moved in a certain direction. So if it's in system terms, you'd say percent profitable, and I want that to be fairly high for myself. It doesn't have to be extraordinarily high, but it's got to be consistently up over different periods. I want it to. I look at the profit factors. I look at the size of the average trades. I look to see if there are any large drawdowns. The biggest thing I look at, the thing that interests me most, is the profit curve. I want to know if, I can look at all the numbers, but they only tell a part of the story. So looking at the profit curve lets me know if it's been a steady edge over a long period of time, or whether it's something that is getting stronger as of late, and it wasn't really an edge 5-10 years ago, or however long ago you're looking back. Or maybe it was a strong edge back then, and it really hasn't made money in 6 or 7 years. And if that's the case, you got great numbers looking back 10 years, but you look back 5 years and it's break even. That's not something that's too exciting for me to kind of base a trade idea off of. So the profit curve in my eyes is the most important piece of information.
So when you notice that the profit curve is or indicates that the study no longer works, what do you do with that study?
Normally I'll kind of suspend it. And if it continues not to work for a while longer, then I'll just throw it out and just say, well, it's not working anymore. If something like that starts working again, I'll notice through something else. But there's a lot of studies that'll do that. I mean, there's some. One of my favorite examples is if you look at in the U.S. the S&P 500. Look at how it's done on Mondays. It's just a simple day of the week thing. But if you say, all right, how is it done on Mondays? If you look back to 1961 or so, which is as far back as I tested it initially, or 60, and you go through the market crash in 1987, you'll see that Mondays were a terrible day for trading, consistently for like 27 years. If you just went short every Friday and then got long again on Monday, you'd be a heck of a lot better off. Or maybe, take a 3-day weekend if you're a trader and don't even work Mondays, right? That's probably the best thing to do. But after the crash of 87, which is the Black Monday, the worst Monday of all time, that changed everything. From then until about 3 or 4 years ago, Mondays then fell in line with the rest of the week. So whatever the market was doing generally, if the market was rallying, Mondays were rallying. If the market was falling, Mondays were falling. Interestingly, Mondays haven't become bad in the last 3 or 4 years, but they haven't participated in the rally. So maybe there's been another change in character. But it's those kinds of changes in character that you need to keep an eye out for and look for, whether it's a system or whether it's just a little simple study like that.
Thanks for that example. I just want to go back to a comment you made about observations of the market. You mentioned a good idea or a good way to get ideas is to just look at the market action for the day.
Yep.
Perhaps the number of down days or up days, percentage of price movement, market breadth, etc.
Exactly.
There could be quite a few conditions that you could test for one day. So how do you handle that? Can you run us through the process of testing ideas for a particular day?
Yeah, so generally it's hardest when the market's in a choppy mode, right? So if you're up today, down yesterday, up today, down, then you're not going to get a whole lot of things that stand out. It's when you hit more extreme, when you see extremes happening. So it doesn't, when I say extreme, it doesn't, I don't mean it's got to be like once in a lifetime thing. I'm talking a 5-day low, right? Could be, that means it's extremely low in the short term, or a 5-day high or a 10-day high or low. So you look for extremes in the data, whether it's, it's the highest volume in 10 days, whether it's the highest high price-wise in 10 days, whether breadth is the strongest in 10 days, whether measures of volatility are reaching the highest level in 10 days, or maybe they're reaching the lowest level in 10 days. You've got this real contraction going on. Both of those are giving you good information. So it's a matter of just kind of looking at things and trying to see where the extremes might lie, and keeping your mind open to, it can be, an extremely exciting thing that's happening, right? Like, wow, we've had the biggest rally in 10 days, or it can be an extremely, I guess you'd say, boring thing that's happening. Oh, it's been the tightest range we've seen in a month, right? Market did nothing today. So what normally happens after you get those really tight range days? So those are the kinds of things I would look at.
Right. So a lot of your studies that you publish on your blog are very simple, perhaps only 2 or 3 conditions.
Yep.
Is that enough to identify an edge that's worth trading?
Sometimes it is. not all the time. So very few of the studies that I post on my blog, and in fact, I'd say probably less than 5% of them are things that I would take a trade on just based on that information. What I do is I will try and look at things from a number of different angles. So if I publish a bullish study, that means there is a bias based on that information. It doesn't mean that there isn't other information saying that there's bearish stuff or that there isn't other information that's supporting the bullish idea. If I can find a number of different studies all supporting a bullish idea or all supporting a bearish idea, that's what gets me excited to take a trade. I also, as a contrarian, I'm a short-term contrarian, I'll say. Short-term meaning a few days. So I like to be on the side of the long-term trend for my trades most of the time. Not all the time. But in the short term, I like to be contrarian. So that means if we're short-term oversold in a long-term uptrend, that's often a good buying opportunity. Short-term overbought in a long-term downtrend, normally a good shorting opportunity. So what I'll do is I will look at different ideas. And if you can take, and it doesn't matter if you're doing simple studies like I do, if you're doing systems. Overnight Edges does it with systems. So what you want to do is take different looks at the market. So price action. With Overnight Edges, I use three measures. I look at price action, I look at internals, and I look at seasonality. And if one of them is lining up okay, that's a nice thing. But if on average, or if all three are saying, hey, it looks like you got a really bullish edge right now, that's a great signal. You know, so if you can take different looks at the market that are unrelated, seasonality is normally a good thing to use. Price action, however you want to define it, could be a price-based system. You could look at breadth as a separate thing. You could look at volume analysis. You could do volatility analysis. There's a lot of different. My Fed Days studies are another thing. So it could be, money flows, or kind of Fed support measures. Anything like that. If you have multiple things all working together, that's generally a good thing. At Overnight Edges, we call looking at the three systems, we call it an ensemble system. And it's actually something that weather forecasters use a lot. Not that they're the best at what they do, but but like traders, they're going to be wrong sometimes. They're going to be right sometimes. But they'll take computer systems, and what they've found is that if you use multiple systems and then look at kind of the averages of what those systems are saying, you're better off than any singular system. So from a trading perspective, what that's saying is that if you have seasonality strong and you've got bullish evidence from price and volume, you're much better off than if you're just looking at one thing. You're just trying to trade seasonality. You're just trying to trade price and volume.
Right. Okay. Thanks. So you mentioned Overnight Edges.
Yep.
For those who aren't aware of what that is, can you just give us a brief outline?
Sure. So the idea behind Overnight Edges, it was something that it was end of 2004 or so. I first ran a chart of the SPY as the U.S. ETF for the S&P 500. And I wanted to see how much money it made if you bought and sold, you bought the open and you sold the close. And then I also did it from buying the close and then selling the next day's open. What I found was fascinating to me, and that was that all of the money and more has been made at night when the market's been closed. If you bought the open and sold the close every day, you would have lost money for many, many years, even during most bull markets. Now, the most recent bull market is the first time since 1993, when SPY was initiated, that we've actually seen a rise during the day. In the bull market of the 90s and in the bull market of mid-2000s, the market basically chopped during the day and then just rose at night when it was close. You'd get a gap up and then chop, and you get a gap up and then chop. Well, what overnight edges does is it tries to break it down to determine when are you more likely to get a gap up and more likely to get a gap down. And it looks at different things, like I mentioned, price action, seasonality, and so forth. So what I do at overnight edges is I look to get long at the close of trading if there's a bullish edge, or I might look to get short if there appears to be a bearish edge, and then I'll get out the next morning, assuming my stop or target hasn't been hit before then. So I'll get in at the end of the day, and I'll hold it overnight, and then I'll get out at the beginning of the next day. Incidentally, I guess I should mention, overnight edges is now part of InvestaQuant. We have a new company called InvestaQuant, and there's day trading strategies that are going to be that are within InvestaQuant, and overnight edges is going to become part of that. So it's kind of going to be around the clock type stuff.
Yeah, I was actually quite amazed when I saw that chart that you published comparing the overnight movement to, I guess, the day sessions.
Yeah, it's fascinating.
It's kind of a little bit counterintuitive. I would have guessed all the movement would be in the day session, but you've got studies that back up that that's not the case. Have you done any other studies that have given you a completely different result to what you were expecting?
I'm sure I have. Off the top of my head, there's a volume study I did that surprised me a lot. When I first started trading, I would trade a lot of breakouts, and the idea was that I was taught at the time was that you want to see high volume on a breakout, right? High volume breakouts are better. And so I did some studies with the S&P 500 breaking out, and what I found was that if it breaks out on volume that is lower than the day before, you've got a better chance of seeing it follow through over the next week or two than if it breaks out on higher volume. And that kind of blew my mind at first. But it's held over the years, and I continue to see it. Now, there is an exception to that, because I then later said, well, wait a minute. What if we got really high volume? And in that case, it's good. So if you see a breakout occur on higher volume, but not extraordinarily high, then it's probably going to get knocked back down. Low volume breakouts, a lot of times the people didn't participate during the breakout. They kind of come in the next day. They see it's still running. Now they start getting into it, and you see the volume come in after that. But if it happens on real high volume, that's been a good thing as well. So if you got a high breakout, and it happens in the highest volume in 10 days or highest volume in 20 days or something like that, then that's a lot better than just a moderately higher volume breakout.
That's interesting. So I guess that goes back to your earlier statement about looking at the extremes rather than, the middle kind of values.
Right.
Yeah, earlier you mentioned in overnight edges that you like to get in on the closing price of the day. How do you do that when you need to run your studies or your scans before the closing price is actually determined?
Well, for overnight edges, the futures close at 4:15, and that's when I'll go in typically 5 to 10 seconds before the close. I start running my stats about 3:45, and then the site updates every minute or so, starting about 5 minutes before 4, so that I can see what the numbers are. And I'm pretty straightforward with my rules, and so if the criteria looks like it's going to meet my rules, I go ahead and take it. And the numbers will sometimes change, and you might get something that happens in the last minute of the day that'll move it from being what should have been a buy to what is no longer a buy, or vice versa. And in that case, if I happen to get in when I shouldn't, well, I'll just get out. Or if I happen to miss a trade, then when it reopens and 15 minutes later, I'll look to get into it. It's it happens sometimes, but it's generally I'm able to run my studies and anticipate the close pretty easily.
Right. Okay. So you also mentioned that for overnight edges, you look at three main components, I guess: price action, internals, and seasonality.
Yep.
Price action and seasonality are pretty self-explanatory, but what do you mean by internals?
Mostly breadth. That's primarily what I'm looking at there. I use different breadth statistics. One other thing I sometimes do with breadth and with other measures is I will look at it comparative to other days. So the thing I do with internals is that's kind of a one-day thing, right? When I look at price action, I'll look at where it is relative to some long and short-term averages, and I'll look at moves that day and maybe what oscillator readings there are and things like that. I'll go into it. Internals is just what happened that day, and then I compare that to, well, how is that rank compared to what happened over the last 100 days, last 200 days, and so forth. So I put a percent rank of what today is versus past periods. And that kind of percent rank lets me know how extreme it is. And what we find, to no surprise, is that when you've got more extreme action, you're going to normally have more extreme edges. So if it's a extremely, and internals tends to be reverting for the overnight a lot of times. So if we've got extremely weak internals, we'll often see an upside edge. If we've got extremely strong internals, we'll often see a downside edge for the overnight.
Right. Okay. Thanks. So you've published a lot of research on your blogs over the years. What's some of your favorites?
My favorites are, I would say, either, well, just the simple price action studies, the things that a lot of times people don't realize. So much panic happens around, when you're hitting a 20-day low or a 6-month low even, or something like that. But when you hit a 20-day low on a big down bar, that's generally a pretty good time to buy. Especially if you're in a long-term uptrend. And so the kind of just simple price action moves. I've got some studies out there. I got one in bear markets that shows, all right, what happens if you, it's from years ago when there was last a bear market, but it looked at, all right, what if you sold short every 20-day high below the 200-day moving average or something like that, and then exited when it got back below the 20-day moving average or 10-day moving average or something like that. And it's a real simple, just kind of short the extreme and get out when the extreme is no longer there type of idea. But those type of ideas tend to work pretty well. The other ones that I always find personally interesting are the seasonality ones. So some of them have worked well for years and years, and some of them have changed over the years, like the Monday one changed over the years. But, things like best 6 months, worst 6 months, which is stolen from the Stock Trader's Almanac. That's worked well for years and years and years. So the S&P 500 has generally done better between November and April than it has between May and October, and it's done a lot better, like not even close. So you're not going to necessarily base a trade on it, but it's interesting information. It's a good thing to keep in the back of your mind, that it might help you set your bias when you're looking at other stuff.
Right.
And when you put it in combination with other things, it can help.
So you mentioned moving averages and seasonality as possible ways to identify, I guess, a trend or market timing.
Mm-hmm.
What other indicators or conditions have you noticed have a big influence on determining market direction?
One indicator I like to use that I show on the blog years ago, and it's part of the market timing course now, is NASDAQ versus the S&P relative strength. So that's an interesting one for me. What it does is it looks at how strong the NASDAQ has been over the last 10 weeks versus how strong the S&P has been. And generally, when the NASDAQ has been the leader, the market has done well. And when the NASDAQ has lagged, the market has done poorly. Now, you would expect, all right, so when the NASDAQ's leading, the NASDAQ's done well, right? So that's pretty self-explanatory. But when the NASDAQ's been leading, the S&P's actually done well. The S&P has made, since 1971, when the NASDAQ came into existence, the S&P has made almost all of its gains when the NASDAQ has been leading it. And that's just part of it's due to the higher beta of the NASDAQ. You know, it's going to be more extreme up moves, more extreme down moves. But part of it, I think, is also due to the fact that when investors are bullish and they're pushing money into the market, and you've got a positive bullish market atmosphere, you're going to get more money going into aggressive type stocks, and those are the ones you find in the NASDAQ versus the S&P 500. They're not all the well-established older companies and so forth. So, you know, and whatever, you can do this with country analysis. You can do it a number of different ways, but the idea that when more aggressive type stocks are doing better, it's a better thing for the market most of the time.
Right. So you mentioned earlier about strategies that have stopped working due to changes in market conditions. What do you think? What type of strategies do you think will continue to work into the future?
Well, it's always hard to say that with any real degree of confidence.
You don't have your crystal ball there?
No. I mean, I think we have seen, I think the same types of strategies will continue to work in the future. So there's going to be ways to make money through mean reversion systems from here forever. There's going to be ways to make money through breakout and trend systems from here forever. But just how you do it, you may need to adapt. So it's very helpful to measure what the market has done over the long term and more recently to kind of let you know how aggressively you want to trade and whether you want to trade a breakout or a reversion. So with breakouts versus reversions, I had an interesting study a few years ago, and I haven't talked about it much lately because it hasn't done much lately. But basically, what it looked at was what's the market likely to do if you have a down day versus an up day. And for years and years and years, from like the 60s through 2000, you saw a lot of follow-through in the market. So that kind of follow-through would mean that if you had an up day today, you're likely to have an up day tomorrow, and you're likely to have another one the next day, and so forth. I mean, if you have a down day, you're likely to have another down day, and so forth. So the market would move in steps. Around 2000, that changed completely. And it got to the point where if you had an up day, you were more likely to have a down day following that, and more likely to have an up day following that. Well, just knowing that, you can take systems and say, all right, how would a system based on the idea of reversion or breaking out do in different environments? So if you use an indicator like RSI2, you can create an RSI2 system that between 2000 and 2009, by the way, in 2009, that up-down little thing, since then, neither of them has worked. So you got 40 years of follow-through, you got 9 years of reversion, and now we've had 6 years of neither being dominant. But if you take an RSI2 system, you can do something simple like say, all right, I want to go long the market anytime the RSI2 goes below 25, and then I'll get out when it moves back above 50 or 60 or 70 or whatever number you want. And then you can do the reverse on the short side, right? And if you're in an environment where there's a lot of mean reversion, that'll work great. If you're in an environment where there's a lot of daily follow-through or short-term follow-through, you actually want to do the reverse of that. You'd be saying, if it gets down to 25, I want to go short. And I want to hold it until it moves back above 25 or 30 or 40 or 50 or whatever. It also affects stops and targets. So if you're in a mean reverting environment, you generally don't want to be using tight stops or maybe even any stops, but you do want to be using targets, right? You want to, because if it moves in your direction, the next move is likely to be back against that. So you want to get out when it hits your target and wait till it gets extreme again, then get out when it hits your target. If you're in a follow-through type environment, you need to take the reverse. You need to say, all right, well, targets I don't want to use because if it goes in my direction, it's likely to keep going in my direction. Mm-hmm. On the other hand, stops, you better use them because if it goes against me, it's likely to keep going against me. Right? So you need to change your approach based on the environment.
Oh, that's interesting to think about strategies working in different environments like that. So I guess it's worthwhile looking at different environments to see how a strategy performs.
Yeah, and it just, you can learn a lot from simple tests like that, and you don't need to go into creating systems. Saying I want to create a system that does this is a very difficult thing to do. But if you say, I want to learn how the market works when this happens or that happens, then you can start to get ideas that, oh, wait, all right, so how would this indicator work with that? And what if I got out and these different ways? And so that it kind of, the learning about the market is what, the system's the easy part after you figure little things out like that.
Mm. If I could just ask you about an indicator or a research study you've published on your blog called the CBI.
Yeah.
Can you tell us a little bit about that?
Sure. So that's my capitulative breadth index. And that's been a real neat indicator for me over the years. I think I mentioned before that my catapult system I designed in like 2004, 2005. And all the CBI really does, the catapult system is designed to identify stocks that are capitulating. And it just looks at S&P 100 stocks. So I was looking for basically extreme sell-offs in S&P 100 stocks. And the reason I just use the very largest cap stocks here is that if you're going to build a system that's buying into extreme sell-offs, you want to have institutional support. So when you're dealing with these real large cap stocks, they've got tons of institutions that own them. When you're dealing with a small cap stock, you might have one or two institutions that own it. So if one of them decides to get out, that could cause the capitulation, and then there's no one there to cause it to bounce. Right. But if you got a lot of institutional support, there's always someone else to buy it back and cause it to bounce. So this is the long-winded way of saying that I'm looking to buy real oversold conditions in individual stocks. And what I found is that when you've got a large number of these individual stocks all capitulating at once, they're all likely to bounce. The market is likely to bounce, and becomes very likely to bounce. And it's been a real reliable indicator for me over the years. So what I do, the CBI is basically just a simple count of the number of catapult triggers I have on at any one time. And what I've found is that when it gets over 10 or so, you've got a real strong indication that the market's going to put in a good bounce in the next few days. And that's not only a short-term bounce, a lot of times an intermediate-term bounce. I think if the CBI has hit 11 or higher, and you bought it the day it hit 11, and normally that's a big selling day, and you sold the S&P 20 days later, so an intermediate-term look, it would have made money every time. It's been like, I don't know, 25, 30 times or something. So it's something that is proprietary to me, but that I share the numbers with all the time. But people can, you could take any system you trade, if it's a strongly oversold indication, and create your own CBI too, and say, all right, am I getting a lot of signals that are saying we're due for a bounce? Market's probably due for a bounce.
That type of strategy must be very difficult to trade, though, if you're looking for, a number of stocks in the top 100 to capitulate at the same time.
So it's it's something that's not a system that I would. You don't base a portfolio on that, right?
Right.
It typically triggers 2 to 3 times a year, where you get these strong market sell-offs, and then you'll get the CBI spiking up. So if you got a system that you want to trade 2 to 3 times a year and take the rest of the year off, then you're all set. But most traders like to work a little bit more than that.
Have you actually had that many signals in the last couple of years for the CBI?
2013 had very few. 2014, we got a few. We had in October there was a strong sell-off, and it picked it pretty good there. I think, I'm trying to remember. There might have been one in August or so that wasn't as strong, but you had a dip that caused the CBI to spike. And then we had another one in it was December or January, just recently, and it picked it pretty good again there.
Oh, so you might get a few more opportunities soon. Who knows?
Yeah. Well, the market's not going to keep going up forever.
No, that's right. If I can quickly, sorry, go on.
I was going to say it's going to go up and up and up until it convinces enough people it's going to go up forever, and that's when it's going to stop going up forever.
Well, maybe the frequency of these CBI events are an indication of a market top. It could be a study you could look at.
Could be, yeah. So we're getting, we've had much more volatile action over the last 6 months or so. I relate that partly to the fact that the U.S. Fed ended their last QE program. So that was kind of a support for the market over the previous few years. And that support's not there as much anymore. They're still reinvesting in maturities, but they're not pumping money like they were. So the liquidity is not what it was. And so you're going to you've had more violent moves since October. And at some point, we'll get an even more violent move than we've seen.
Yeah. Before we wrap up, if we can just have a quick chat about the Fed actions, because you've released a really interesting study called the Quantifiable Edges Guide to Fed Days.
Yep.
Can you give us a little bit of information on what that is, how it came about?
Sure. So that just really looks at action on and around Fed days. And I define Fed days as the days where they wrap up their meetings. The meetings happen 8 times a year. And it used to be sometimes 1 day, sometimes 2 days. In the last several years, I think they found a better deli, so they have them all be 2 days to get lunch in. But so you got all these 2-day meetings. So it's the second day, the day where they announce any policy changes and just kind of a statement on the economy. Those Fed days, I went back to like 1981, and they have consistently done substantially better than the market, to the tune of like seven or eight times better, as far as the expected amount that you'd see the market move up on a Fed day versus any other day. But they're not all like that. So what the Quantifiable Edges Guide to Fed Days does is it breaks down the Fed days. It breaks down what happens leading up to a Fed day, what happens in the actually on the Fed day. The most interesting part to me is the fact that these Fed days have done so well over the years, but most of the edge, the upside edge, happens between the close the day before and the actual announcement. So after the announcement's out, it's just, random swings. It's leading up to the announcement where you've had the upside drift most of the time. And then I also look at, what happens in the days afterwards. If the Fed day does things like pushes the market to a new high, or if it pushes it to a new low, if you get a bad reaction to the Fed and things like that. And there's certain environments where you're more likely to see a Fed day rise versus others. So I kind of break it down in a number of different ways in the book. Book's a loose term. It's if you've seen it, it's a large pamphlet.
Don't undersell it. It's a great book. It's full of loads of great information. So I was just going to ask about the results in that book. I think they go up to maybe 2010 or 2011.
Yeah.
How have the studies performed the last few years now that interest rates are so low?
They've actually held pretty consistent. There was a period where the Fed days in general kind of drifted sideways right after I published the book, just to kind of make me look dumb. But that's changed, and it's started working again since. But the breakdowns have stayed pretty good. So if you get weakness going into a Fed day, that means people might have anxiety about what the Fed's going to say, and they might be exiting positions ahead of the announcement. And what happens is most of the time the announcement isn't like worst case scenario or as bad as they fear, and you get a nice little rise. But if people push the market higher into a Fed announcement because they're anticipating something wonderful happening, normally it's not as wonderful as their imagination either, and you don't get as strong of an upside edge. Although it's not a downside edge, it's still, you still get it's a smaller upside edge for those Fed days. So conspiracy theories can abound. Is the Fed making themselves look good, pushing it higher, or what's going on? But I don't care what the reason is. I just care that I can, see what's worked in the past and hopefully make some money off it continuing.
Right. Well, thanks for sharing that with us, Rob. So if we can just wrap up with a few quick closing questions.
Sure.
What's the biggest lesson you've learned through trading?
I guess trading's like life, it happens in bunches. So you're gonna.
What do you mean by that?
Well, you're gonna have boredom. You're gonna have excitement, and you're gonna go through periods where nothing's going on, and you're gonna go through periods where you're just losing your mind because you can't keep up with it all.
Right.
And normally, it seems to go along with life too, I guess. when you get a lot of personal stuff going on that you want, that you could use a break from the market, that's when the market gets exciting.
How about what's the best trading advice you've ever received?
I would say you need to make sure that you verify that you have an edge. Too many people just trade what they believe rather than understanding what the edge is. And so anything you can do to learn to verify that edge, I think is a good thing. You also need to make sure that whatever style of trading you try and employ fits with your lifestyle. So day trading is an awful tough thing to do if you got a full-time job, right? It's also a tough thing to do if you got screaming kids in the background. So if you want to only have to look at the market at night when it's quiet, then take an approach that will let you, put your orders in at night and not have to worry about what's going on during the day. Or maybe you look at it once a week and you're taking kind of a long-term approach. Or maybe, you're okay. You find it exciting. You like day trading or whatever. Just find something that fits you. Because if trading's challenging enough for a lot of people that if you have it clashing with the challenges of your own life, it's going to become really difficult.
That's great advice. Thanks, Rob. Can you share a personal habit or behavior that you strongly believe contributes to your success?
Oh yeah, it's the work I do at night. So ever since I really first started trading, I would whether it was my day trading in the very beginning or even more so now, I believe the money I make in the markets is really made the night before or the weeks and years before, months before. It's the preparation for the trades. So execution of a trade is that's nothing. That's I put it on, I take it off, but it is the habit of taking a fresh look every night and really thinking about, do I still have an edge in this trade, or is there a new edge that I should be looking to take advantage of? That's what really gets me set, and that's what allows me to execute during the day. If you come into a day unprepared, it's like anything else. If you're unprepared or you're trying to react to the market as things are happening, very difficult to beat out everyone else on Wall Street, right? But if you have a plan and you're prepared, then you're just so much better off.
Yeah, I think Muhammad Ali said a similar statement, something about the fight is won before you even enter the ring. So
yeah, exactly.
Yeah,
that's a great quote. Yes.
Yeah. Favorite trading books?
Well, I got a few. Not too many, but I always loved Market Wizards. I thought that was a neat one to go back and look at the interviews. From a psychology standpoint, I always liked Dr. Steenbarger's books. I think he does some great work. So I would look at those. As far as little trading ideas, Larry Connor's How Markets Really Work. I thought that was a neat book when it first came out, and it gave me a lot of ideas to just go and test and start in my own ideas. Plus, you can read it in about an hour. It's a short book. One I liked recently that I read, I don't know, a year or two ago was Jay Capel's Seasonal Stock Market Trends. Jay has a lot of interesting work, and I thought that was a neat book as well.
All right, thanks for sharing. Yeah. So finally, what's the best way for listeners to get in touch with you?
Support at quantifiableedges.com. They can find me at Quantifiable Edges. You can also find me at investaquant.com, which is what Overnight Edges is moving to. So Rob at investaquant.com or support at quantifiableedges.com. they can reach me.
Right, okay. So thanks for your time today, Rob. I highly recommend everyone go and check out Rob's websites. I'll have links to those in the show notes, so they're easy to find. Thanks again for your time today, Rob. Appreciate it.
Thank you, Andrew. I appreciate you inviting me on and enduring all my babble.
Thanks a lot. It's been a pleasure.
All right.
All right, cheers.
Bye-bye.
Bye-bye. Great interview from Rob Hanna today. Here are my top takeaways from this episode. The first was making little observations about the market can give you loads of ideas to test, and you can learn a lot from the simple ideas. So keep track of them, notice how they've performed in the past and recently too. And these ideas can be combined with other components to form a strategy or used to gain a better understanding of how the market behaves. Also, when looking for ideas, pay attention to extremes in the market action because they're normally going to have more extreme edges. Also, by looking at the market from different angles, like price, action, internals, and seasonality, and combining these studies into an ensemble system, you can be better off than just following a singular system. I also like the point Rob made about the money that we make in the markets is really made in the research and preparation completed the days, weeks, months before we even enter the market. So it's very difficult to beat Wall Street if you're unprepared. What were your top takeaways from this week's episode? Leave a comment in the show notes. It would be great to hear what you thought. Don't forget to check the show notes for this episode. We have more information from the interview, including additional resources that we discussed in our chat with Rob today. Also, check out the blog. We have a basic shorting system that Rob mentions in the interview. We provide strategy rules, the results, and you can also download the Amber Broker code from there too. So check that one out. The show notes can be accessed directly by typing bettersystemtrader.com/7 into your browser, and you'll jump straight to the page. Next week's guest has been trading the market since 1989. He spent thousands of hours researching the market, stock and technical analysis criteria to understand what really worked and what didn't, and using his mathematics and computer science skills to come up with a way for the computer to do the analysis and heavy lifting for him. His work has been widely referenced and quoted over the years. He's been a guest speaker on TV, radio and print, including Sky News, ABC Radio, Your Trading Edge, Switzer Daily and the ASX. In the chat, we discuss market timing, why it works, the impact it can have on strategy performance, and simple methods you can test for yourself. We also discuss the misinformation published by some fund managers, how simple techniques can be used to outperform the professional money managers, the importance of perspective and how it can improve your trading, and one of the key components to executing your trading plan or strategy correctly. Anyway, that's it for this session. If you're enjoying the podcast, please take 2 minutes to submit a review in iTunes. It would really help to spread the word. Thanks for listening to Better System Trader. Catch you next week. Ciao.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.